Today we will deep dive into how Coca-Cola became one of the most prominent and boring stocks ever, in what manner Coca-Cola said no to the rules of Wall Street, plus we will analyze its astonishing longevity, as this might be the key reason to hold this stock forever. While the S&P 500 index and the high-growth Nasdaq index are hitting one record after another, and even the hype around high-risk leveraged ETFs is growing substantially within personal finance, Coca-Cola stock looks like an old-fashioned, outdated tanker. Why should anyone buy a stock generating 57% in the last 5 years when you could have hopped on the AI train with Nvidia's 1,340%? Or even better, yes, that's possible, invest in the military stock of Rheinmetall from Germany with a jaw-dropping 2,661% gain in the last 5 years. Well, hindsight is always 2020, and as long-term defensive investors, we favor longevity and reasonable valuations. One of those gems praised by Charlie Munger, Warren Buffett, and even their mentor, the father of value investing, Benjamin Graham, is the dividend aristocrat Coca-Cola. To explore how Coca-Cola has become such a behemoth, we will dig into a quick history lesson. In 1919, Coca-Cola had its IPO at the New York Stock Exchange with an initial stock price of $40. A single stock from 1919 would have been equivalent to jaw-dropping 9,616 stocks today, thanks to one stock dividend, meaning for each share the shareholder received one additional share as dividend, and 10 different stock splits during 1935 until 2012, resulting in a total amount of 9,616 shares for just one stock from its IPO in 1919. Combined with reinvested dividends, the single stock from 1919 would have compounded to over $12 million. Now, one can say, well, not everyone can live over 160 years. Coca-Cola is in the pool of multi-generation stocks which will not deliver high returns near term. Instead, this theme results in a company culture that says literally no to the rules of Wall Street by thinking super long term. In recent years, upcoming beverage brands like Celsius or Monster have sipped a good amount of Coke's market share, especially the whole energy drink segment was a tough play to counter for Coke, as they always wanted to offer a family-friendly beverage. Stocks like Monster have annual revenue growth rates in 2022, 23, and 2024 of 14%, 13%, and 5% respectively. At the same time, Celsius smashed the competition with 107%, 101%, and 3% of revenue growth. Meanwhile, Coca-Cola has rates of 11%, 6%, and 3%. While Celsius made a loss with a negative EPS in 2022 of 88 cents, they jumped above the green zone in 2023 with 77 cents, but shortly declined to 45 cents in 2024. Monster held strong with $1.12, $1.55, and $1.49, while Coke was the most stable of the three, with $2.19 in 2022, $2.47 in 2023, and $2.46 in 24. So we can clearly see Coca-Cola's boringness, which leads to the question, is there even a growth potential? As of today, Coca-Cola is a behemoth with a $303 billion market cap, while Celsius and Monster have $10 billion and $68 billion respectively. To catch up to the high growth rates of innovative brands as an established player, you have to work even harder. This was the key reason for Coca-Cola buying a large stake in Monster Beverage of 16.7% back in 2014, which was not an unusual transaction for Coke. Besides internally developed brands like Sprite, Powerade, or Fanta, and sugar-free derivatives like Diet Coke or Coke Zero, multiple acquisitions happened, but one of the most profitable trades was the takeover of lemonade and orange juice producer Minute Maid, which was ahead of its time with its frozen concentrate orange juice and helped significantly to diversify the product portfolio beyond carbonated soft drinks. One important metric is the operating income, which is the profit a company earns from its core business operations, after deducting operation expenses such as wages, depreciation, and cost of goods sold, but before taxes and interest expenses. From Coca-Cola's operating profit, we can deduce which segment is the most relevant for the stock, which is the $7.6 billion for trademark Coca-Cola and $3.2 billion for sparkling flavors, as well as Monster or cooperations with Jack Daniels or Absolut for ready-to-drink beverage partnerships. Additionally, water, sports, coffee, and tea with brands such as Fuse Tea and Powerade add $3.4 billion. Meanwhile, juice, value-added dairy, and plant-based beverages such as Minute Maid add another $1.3 billion. We clearly see that Coke's core generates 50% of profits. Sparkling flavors and the water segments accounts for 20%, and juice for 10%. The strength of brands like Coca-Cola Classic, Diet or Zero, Sprite and Fanta accentuates resilience against new energy and vitamin beverages like Celsius and Monster. Nonetheless, Coke was making a smart move by investing in Monster as a backup plan. This mentality of having a margin of safety is in par with the way of Benjamin Graham's taught investors to handle their stock investment. Another factor is dividends. With this historic document on their website, one can see how many dividends Coca-Cola has paid since 1920. For over 105 years, Coca-Cola has been paying dividends, which underlines its strength and resilience. On the top of this ultimate dividend history, Coca-Cola also increased the dividends in the last 63 consecutive years, with one special year in 1988. The cash dividend looks like it was dropping to the prior year, but instead Coca-Cola was paying additional dividends to the regular one with a special payment from selling one subsidiary called KPE. KPE was the ticker of Columbia Pictures Entertainment, a movie company owned 49% by Coke. In 1989, Coca-Cola sold its stake to Sony Pictures, which artificially increased the dividend. The dividends, accounting for all stock splits in 1988, were $691 plus. A year later, in 1989, the dividend was $783, which seems at the first glance like a decrease. Instead, the dividend increased from $691 to $783. A company is a dividend aristocrat when it has paid a dividend for the past 25 consecutive years and also increased the dividend year over year. A company can call itself a dividend king when it has a dividend growth streak of at least 50 years. Coca-Cola's achievement of a 63-year continuous dividend growth streak means this stock is one of 56 companies worldwide that are in the golden club of dividend kings. Other examples are Caterpillar with 32 years, an aristocrat, Pepsi with 53 years, a king, or McDonald's with 49 years. They are on the edge of becoming a dividend king next year, but that's for another video. Coca-Cola's dividend yield of approximately 3% is above the median from all dividend kings of around 2.6% yield. Now let's talk about valuation. As Buffett once said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And that's what Coca-Cola stands for, meaning it's smarter to buy a financially healthy stock with a great track record, less hype, offering a substance, and a brand that can persevere the storms of a dot-com crash like 2000 or a pandemic shock such as in 2020. That's why Coca-Cola might be the perfect fit for an AI-independent trade, since customers still stick to their long-lasting habits. This year, Coke's earnings per share, or short EPS, was 77 cents in Q1, 88 cents in Q2, and 86 cents in the last quarter Q3. In total, they delivered $2.51 within the past 3 quarters, which already marks the best earnings for Coca-Cola. Keep in mind that we still have 1 quarter's earnings to go for in Q4. Since Q4 is unknown, we will focus on the last 12 months earnings from the last 4 quarters, namely Q4 2024 to Q3 2025. Which would be 51 cents from Q4 2024 plus $2.51 from Q1 to Q3 from 2025 equals $3.02. With the current stock price of $72.95, we result in a price to earnings ratio of 24.2, which is below its 10-year median of 27.8. Yes, this is just a discount of 13%, but the amount of quality you get is remarkable, especially if you want to hedge against the undeniable risk of AI stocks. Sure, Coca-Cola is by no means a T-bill and comes with a risk. Its defensive, long-lasting character shines when the Wall Street flips from risk on to risk off mode. This chart shows the drawdown in percent from peak for the last 10 years from Coca-Cola, which had its 3 toughest days during the pandemic in March 2020 with negative 37%, negative 16% in 2022, as well as negative 17% in 2023. Meanwhile, Nvidia had drawdowns of negative 56% in 2018, negative 66% during the interest hike by the Fed in 2022, and negative 37% in April this year during the sell-off due to tariffs. Of course, Nvidia's earnings are jaw-dropping, but the risk should not be underestimated and is increasing with PE ratios of 57. To answer the question, is Coca-Cola a hedge against an AI sell-off, we can characterize 3 major benefits of their brand. First, the customer base and sentiment are steady due to brand loyalty and the small luxury effect even in tough economic times. Second, the disconnect from technology is an advantage as their main product is a beverage and not at all correlated with the semiconductors, complex high-tech product chains or rare elements. And third, Coke is producing directly near the end customer. Their business model is substantially less vulnerable to potential shortage of semiconductors and unstable supply chains. And finally, as defensive and long-term investors, we appreciate financially healthy investments in future product and product lines. In the last 12 months, Coca-Cola's capital expenditures have been around $2 billion. Meanwhile, a high-growth consumer of Nvidia chips, such as Meta, has a capex of over $62 billion just within the last 12 months, which is 31 times as high as that of Coca-Cola, with no certainty ever being profitable for the stock. To ensure your portfolio lets you sleep well, a diversified, stable, and astonishing dividend king for 36 years might be worth a glance, especially at current PE ratios of 24.2. Thanks for watching and see you in the next one.